Markets have moved higher on cooling trade tensions between the world's two largest economies. But our guest today says investors may now be in the eye of the hurricane. Joining us now to discuss is David Sekera, Chief U.S. Market Strategist with Morningstar Research. And David, thanks for joining us. Welcome to the show.
Oh, of course. Good to see you again, Anthony.
You too. All right. Well, we've seen markets take a round trip since the big sell-off in April. But you say that we may be in the eye of the hurricane right now. So let's walk through your thinking. We'll start with the U.S.-China trade relationship.
Mm-hmm. Yeah, and first, maybe just to give you a little bit of background as far as, why I feel that way. When we came into the year, the market was trading at a slight premium to a composite of our fair values. And as you can imagine, a lot of that overvaluation was concentrated in AI stocks. Then in later January, the storm really started when DeepSeek hit the headlines. That forced the market to reevaluate a lot of the valuations and the premiums they were paying on those overvalued and overextended AI stocks. But really, the landfall of the hurricane hit on the day that the Liberation tariffs, were announced. Of course, that started the market really just dropping like a rock at that point in time. We actually hit bear market territory, being down, 20% from the peak of the market. And in my mind, the market at that point felt too far, too fast. In fact, on the April 7th episode of The Morning Filter, which is our weekly podcast, we recommended investors to start moving to an overweight. At that point in time, the market was trading then at a 17% discount to fair value. Of course, President Trump then announced his 90-day pause, that first pause that caused stocks to bottom out and begin to recover. And now investors, turn their attention to earnings. Generally, I'd say earnings season has been pretty benign. And of course, most recently now this reduction in tariffs, with China for the next 90 days. So when I think about everything that caused that April sell-off, the issues that really forced the market down, those really haven't been, really resolved at this point. So when I think about the tariffs, the U.S. still needs to engage with the EU in a meaningful way. So we'll still have, a lot of back and forth in the headlines there. And, the tariff reduction in the 90-day pause with China, certainly a good de-escalatory first step, but still only the first step. When I think about, China, they're just not going to roll over and acquiesce to U.S. demands. I think negotiations here will be very hard fought. I think it will take a very long period of time, to get to, the end goal here. So I think we'll probably be bumping up against that deadline. And of course, as we get closer to the deadline, the market's not going to like that. And then I also just have a concern, China might play hardball. They might, try and leak, to the marketplace, some negative headlines here and there in order to try and push U.S. stocks down to be able to further their negotiation, positions as well. And then lastly, the intent of the tariffs is, to bring manufacturing capacity, back to the United States. While overall that might be good, over the long term for the U.S. economy, it's going to take a while before that really shows up in the real economy. And in the meantime, I think that, all of this really could cause a lot of dislocations and disruptions in the short term.
Okay, given that backdrop, another aspect that hasn't changed is Fed rate policy. Why don't you walk us through your thinking there?
Exactly. I mean, right now, the Fed is on hold. They're probably going to be on hold for a while. And, I did listen to, the last meeting, listen to, the press conference afterwards, and kind of, I think the synopsis here was, it just ended up being much ado about nothing. I heard a lot of words. I heard them talk about how the trade negotiations are unclear exactly how they're going to pan out. They did mention that they thought the tariffs would lead to inflation and weaker economy here in the U.S. in the short term, but they really don't know what those long-term impacts are going to be. So for now, they are waiting for more hard data to come in and either show inflation and inflation expectations are rising, in which case, they could actually increase the federal funds rate, or that the data may show them the economy is slowing faster than expected in the U.S., which, of course, if that were to come true, they then would lower rates. Both of those of which either occurs would also be bad news for stocks.
Okay, you touched on the economy because we've heard, some potential, outcomes of a recession. Earlier in the year, we heard that we could potentially get a soft landing. What's your thoughts on the general state of the economy? And you say that there's still some signs of weakness there.
Exactly. So our base case has been and still is, no recession. But even before the Liberation Day tariffs were announced, the Morningstar U.S. economics team had already forecasted the rate of growth in the U.S. would slow sequentially this year, such that each quarter we'd see slower and slower growth, and not bottoming out until the end of 2025, and then just looking for modest growth in 2026. Now we've already seen the tariffs cause a number of different disruptions and distortions in the numbers. So, for example, U.S. GDP has already been distorted by a lot of pull forward. A lot of companies tried to front run the tariffs by importing whatever they could before the tariffs would go into effect. That resulted in a negative GDP print, for the first quarter. Now, we think that GDP is actually going to look very good on a headline basis here in the second quarter. We're forecasting, 2% growth, but that's really just because those companies will then be using up that inventory that they bought, in the first quarter. But we think kind of the real fundamental, the real underlying economy is still slowing. And I think there is a lot more potential disruptions and dislocations and additional downside risks at this point.
All right, of course. And now as the summer is just around the corner, an old adage in the market is sell in May and go away. How should investors be thinking about positioning right now?
That might be a good idea this year, but no. All kidding aside, the U.S. stock market right now is trading at about a 2% discount to fair value. I would say that it's just a very slight discount, really hardly any margin of safety, even though we do have, a lot of near-term risks. And, in this context, I would just note that when we changed our, market recommendation to overweight on that April 7th episode of the Morning Filter, the stocks were trading at a 17% discount to fair value. At this point, we've recaptured all of that. Now we're back to more of a market weight position. But I do think positioning is especially important. So I would just recommend for investors, stick with those companies that are just very high quality. Look for companies that have long-term durable competitive advantages. Specifically companies that have pricing power to be able to put through their own cost increases, but also those companies that have negotiation power with their own suppliers. At this point, with where stocks are, I just don't think you're really getting paid to take on the additional risk of looking at low-quality companies today. We still like value stocks. They're more attractive to us than growth. Value stocks are trading at a discount, whereas growth stocks are trading at a premium according to our valuations. I still like stocks that pay attractive dividend yields. So while there may be kind of the rebound of the hurricane, you can still get paid to wait to get through the storm. And then also, we'd still like small cap stocks. They're trading at a very large discount to our valuations. I just have to caution, it might be a while before small cap stocks, start to work. Historically, small caps do best when the economy has bottomed out and it's starting to reaccelerate. A tailwind of the Fed cutting the federal funds rate is always good for small caps as well. But I just don't see that necessarily happening, until well into, later this year, if not maybe even into 2026. But with small caps, it doesn't take very much of an big allocation coming out of large cap into small cap to get those to start moving, very quickly. And then lastly, just to round that out, I do think, there are a couple of themes, that we're looking at this year that I think that in any market will play through. I still think 2025 is the year that investors are really going to start focusing more on those companies that can utilize artificial intelligence to be able to drive revenue, cut their own costs, and start getting away from those companies that were all the AI hardware providers. Those were the big winners of the past 2 years, but for the most part, a lot of those do seem to be fully valued. And then more recently, with President Trump overseas making a lot of different trade deals, we see a lot of value in defense and aerospace companies, as well as those companies that will benefit from foreign investment getting put back into the U.S. So I'd look at like engineering and construction companies, industrial and commercial building suppliers, and tech hardware suppliers as well.
All right, now we touched on some of the big risks out there. Now that we're kind of at the tail end of the latest earnings season, how are corporate profits looking to you? And do you have any big takeaways from the latest earnings season?
Really not a lot of big takeaways. I think first quarter earnings were generally benign. Most companies were able to make, their earnings estimate, and hit their guidance numbers. Now, I would say anecdotally, and I don't have the data on this, but I did see more companies miss on the top line, as far as revenue growth than I think what I've seen the past couple of quarters. So I just note, most companies, they do have, a couple of different levers that they can pull, in any one individual quarter to be able to meet their EPS guidance. But you really need to get that top line line growing again. If you don't have that sustainable top line growth, you really can't drive, the long-term earnings growth. So that's one area that I am concerned about, here in the shorter term. And then I'd also note too, I was reading some data coming out of FactSet. I think they noted that a higher percent than usual of Wall Street analysts were lowering their second quarter earnings forecasts as well. So don't want to be, negative Nancy. I still think that over the long term, you will get very good returns in the stock market. It is at least trading at a slight discount to our fair values, but I do see a lot of headwinds here in the short term.